All right, that is the countdown. We are back live, full screen. It is Sunday night, 9:05 p.m. 9:06. We were a minute late going live. But thanks to those of you who have tuned in for our weekly stock market scan. Lots to talk about. There's a pretty entertaining week, I think, coming up in the market. We also had a pretty entertaining week last week. For some reasons good and some reasons bad, but in aggregate, it was a very, very good week for us. So without further ado, and because I can tend to just sit here and talk about nothing in particular for way too long, let's go back to the profit tracker and get things kicked off as we talk about last week first, and then we'll get into what we're looking at for the upcoming week. Talk a little bit about the calendar of earnings, talk about the economic calendar. Going to be a lot of action out there, and we are doing a giveaway again tonight for an HT branded tumbler. I was looking around, I think mine is in the washing machine right now. But if we get up to 30 live viewers, which you can see down over here, but like a little further down the screen, we will be giving one of those away to one of you live. So keep an eye on that. We're going to get it one of these days. It's going to happen. I can feel it. But recapping last week, we made $2,212. Could have been a lot worse, could have been a little better, but typically when you're saying something like that and we've accomplished our goal of returning over 1%, fantastic week. We did our job in the market. A lot of really, really cool things to talk about. The first of which is that we just wrapped up the month of July with a profit of $5,405, which slightly underperformed the S&P 500. But as we know, look, if the S&P 500 went up 3% every single month, it would be going up like 35-ish, 40% in a year, and that's just not going to happen, quite frankly. So we're happy that we were able to get these returns, and even more notable is the fact that the S&P 500 went up a lot, but we talk about this a lot because the big question we get is, hey, this is going really well when the market's going up, but what about when the market goes back down? But frankly, we could look at these positions we've held over the past month. A lot of these are bearish positions, a lot of bearish positions in here. There's a lot of bullish ones here, but our portfolio is mainly bearish position size that week. Bearish again here. That's the point that we want to put forth here, and it's important to think about because yes, we did underperform a little bit, but we would have done even better had the market done worse. So we're not relying on the market for our returns, right? The market trading flat is best case scenario for us. So we're going to keep doing what we do. The idea is consistent income generation and avoiding having any of those big dips. We've done a very, very good job of that. In fact, we've only had 2 individual weeks this entire year. And now that we're kind of to the back end of July, there have been 31 different weeks this year. Only 2 of them we have lost more than $500. And the average size of our winning week, if we do the math here really quickly, the average winning week is, bear with me, $1,500. Right, so on the winning weeks we averaged 1,500, and on the losing weeks we've only had 2 that were larger than a $500 loss. So all is well, strategies being executed. Let's recap last week, talk about what we did well, what we could have done a little bit better, and maybe discuss some of these trades because some of them carry into next week. So let's talk about those a little bit. And the first of which is going to be Restoration Hardware, ticker RH. And for those of you who have been following along, you know that last week was the second week or kind of the third week that we've been in this one. We started with a 340, 360 call credit spread. We sold it a little further out. It didn't really work off the bat because if we look at Restoration Hardware, right, if we bring this chart up over the last calendar month or so, what we're going to see, there you have it, a very, very big run up. And this is the 1-year chart. And typically what we like to leverage, what we like to lean against is this RSI metric down here, this red line on the bottom. Anytime this gets above 70, the stock is considered to be overbought. And typically it's a pretty good indicator historically of when something's going to take a little bit of a turnaround. Now that's not to say that this thing is going to go from 387 all the way back down to 350 or something like that, but it wouldn't be unreasonable to expect it to, one, either stay flat around 387 or two, come back down into the 370s. Historically, when we look at these peaks in RSI, they coincide with short-term peaks. Another RSI peak right here back in January, resulted in a drop from 323 down to about 290. So there's decent precedent historically for RSI being, up this high and then falling back down, the stock price. So if we look at the S&P 500, we'll notice that this is, again, Restoration Hardware. We might say, okay, these peaks you just talked about, HT, They were very, very short peaks. In fact, RSI for Restoration Hardware has been above 70 since June 26th. That's over a full month, which is a lot. And this started with it just above 300. So what we did was we waited a little bit. We chased it up. We actually took profit one time off this initial dip right here. And the point I want to emphasize is that that little dip is just such a small move. That's all we need to make a decent bit of profit. Ricardo A in the YouTube chat, appreciate you checking in. Thanks for tuning in and leaving us a note. But these two big red candles, we've been chasing it up ever since. So last week, what happened? Excuse me, 2 weeks ago. Let's get back to the beginning here. We had this 340, 360 strike spread. We said, okay, this thing has run up past 360. Let's take profit on the 360, leave the 340 naked, roll it up, yada, yada, yada. But all in all, the first week where we started, managing it, so to speak, we lost 1,145 bucks. Enter last week, where we rolled up from 375, which is what we had when we doubled down on the position, going from one contract size to two contracts. We doubled down. We were down 1145. We kept that two-sized contract, and we went from a 375 strike to a 385 strike. And what you'll notice is that Restoration Hardware went from 378 to 387. So it went up about $10, about 3% last week. Yet, thanks to the fact that we rolled this strike up, even though we had a bearish position, we actually made, in aggregate, $810 on Restoration Hardware. So we've got this really gross, nasty-looking loss from a couple weeks ago, which ended up netting out to about 1,145 bucks. We add in last week's activity. All of a sudden, this trade, where we've had a bearish position on it, and it is sprinted up against us. We've played it down from about this level right here. It's run up really, really quickly against us. We're only down 335 bucks, and you'll notice that 2 weeks ago we rolled this thing from 375 up to 385. We did the same thing for this upcoming week, where we rolled from 385 up to 392.5. Not quite a $10 jump, but the idea here is we've kind of been riding this thing for so long. We've been, digging our heels in, managing the position, rolling up. It's been 3 or 4 weeks, but we don't just want to break even here, because now if it stays above 392.5, and it finished last week at 387.29, if it stays below 392.5, we hit max profit. That's $936 for this coming week, and all of a sudden, this stock right here, even though over the past month when we've been trying to play it down, it's looked like this, so long as it stays under this red line right here, we're going to make $600 on it over this stretch with bearish positions exclusively. That is something that I cannot emphasize enough, because we're going to have losers. Things are going to lose. But if we could just keep managing, just keep kicking the can down the road, right? I think buying options is such a bad value proposition, because you could buy these things, but there's a set expiry on them. The great part about selling these is, yes, these options have an expiry, but we could do what we've demonstrated. We can increase position size. We can roll these expiries out. So just because we start with a July 21st expiry doesn't mean that we could roll the strike up for July 28th and then up again for August 4th like we've done for the upcoming week. So that is where we sit with the Restoration Hardware. It's a little bit frustrating, objectively, because last Friday we were in a position, right, where we had that 385 strike and this, just below this red line. And if it finished below this, we were going to be looking good. And in fact, on Thursday afternoon, it closed at 380, and we thought, hey, we might be able to get max profit last week, which unfortunately didn't happen. We would have collected about 500 more bucks. But it could be one of those situations where it's a little bit of a blessing in disguise, because if Restoration Hardware finished at like 375 or kept going down, or even finished around 380 and we were able to take max profit for 500 more bucks, we may not have played it again this upcoming week. So we could be in a situation where, yes, we leave $500 on the table by not getting max profit last week, but we could come right back and get $936 of profit, which is, 400 more. So one of those blessings in disguise that, even though it sucks last Friday when it moved against us, it gave us the opportunity to get into a higher spread next week and be looking at potentially more profit overall on Restoration Hardware. Now, of course, the flip side of this, I don't want to make this all seem so one-sided, like, oh, this is so easy to make money, because it's never easy. We win a lot, but things can move against us. If it goes up to like 400 or something like that, if the stock is up to 400, has a similar move this coming week, yeah, we lose 564 bucks. So we're not out of the position yet, right? We're not out of the woods. I really like the way it sets up, but again, things are still going on. It's not over yet, but I like where it is and how we've managed it, despite, again, this 1 month move against us. It's been very, very difficult, very, very stressful, honestly. I mean, I don't get too stressed with the positions, but maybe slightly frustrating is a better way to describe it. But that is one of the positions we have for next week, and it is one of our positions from last week that even though it moved against us, right? This is the single point that I cannot emphasize enough. We had a bullish or bearish position. We wanted it to go down, but it went up from 378 to 387. Yet Restoration Hardware last week was our biggest winner, $810, just because we gave ourselves that cushion, rolling that strike higher, and we're taking advantage of that extrinsic value. The other thing that we did here, and you'll notice it on row 801 right below it, is this extra $206 here. Where did this come from? During last week on this 5-day chart, when it really started running up, we said, okay, I potentially could see myself increasing position size here because I believe in the thesis that Restoration Hardware is going to fall back down. However, I don't know if I want 3 naked calls. So I think a good compromise, so to speak, was just selling another spread. That way it's a defined gain, defined loss. So if anything too crazy happens, these will get damaged, but this position won't get torched too badly. And then if we get the move that we want, excuse me, which is what happened, we get $2.06 of premium, which, again, contributes to lowering that overall loss. The overall loss that was at 1145 went down to 335, and hopefully we could be talking a week from now with max profit on this trade, be looking at $601 of profit overall on it. But that's a good example of how you keep rolling these things week over week. Just keep kicking the strike higher and higher if you have a bearish position like this, or lower and lower if you're selling puts for a bullish position. But right now, market is super overbought. So we're just continuing to ride with these bearish positions until we get that nice little payoff. And again, like we said earlier, the market is having an incredible year. We're trailing the S&P 500 a little bit, NASDAQ by a lot, but that's what happens because if you look at the bigger picture, we're crushing both of those. So I'm not terribly worried about one-year performance on that. But we're not dependent upon this. In fact, we'd love it if the market dropped like 3 or 4% next week because we'd crush it. We'd take home max profit on all these. We'd take home another $2,000 and we would avoid a dip in the market. That would be fantastic. But with that said, 1 week at a time. And that's an example of how we can take these trades 1 week at a time and manage them bit by bit by bit by bit. So going back up, recapping a little bit further. UPST is kind of our one loser last week. And even though we lost on the position, I think we handled it very well. And again, this is one thing we talk about every single week as well. You could have losing trades, but is the losing trade a result of something just not going your way? Or was it a result of a stupid trade that was a little bit misguided and poorly managed? Those are the ones we want to avoid. This one, I think, was not a result of poor management. In fact, I think we managed it really well. You'll see that we started with the 55-65 call credit spread, $10 wide, 222 premium. I think we had about like an 8 to 10% cushion to the upside at the time we opened it, so I liked the risk to reward. However, UPST, Upstart, has been going kind of insane over the last month or so, which we can see from this chart, going from 34 to 65. And if we zoom out a little further, it's a little crazier, bottoming out at 1193 and coming all the way up here. But again, 1 year chart, RSI, 72.77, things running way hot. So we just put a bearish position on. We trust it. We use these credit spreads, right? Because when we see action like this is when we want to use a credit spread. We like credit spreads because they're defined gain, defined loss, more importantly. Where naked calls, a stock could go up infinitely, you'll get crushed. If the chart looks like this over the past year, that is the chart of a stock that, can go up a ton, right? It's already up like 5 or 6x. But if we look at something like a Restoration Hardware, a little less volatile. Yes, it's up a decent bit from the low, but obviously nothing like UPST, going up 5 or 6x from the low in just a few short months. So this is why we're sticking with these call credit spreads. Now, again, just because we have one call credit spread doesn't mean that we can't do anything to manage it. What we did here was once this got breached and was moving up towards about 63, 64, we rolled it higher and we doubled down. We went from 1 to 2. And the great part about this trade is that this netted out for a loss of $228. Had we held on to the initial trade, it finished at 65.18, meaning this would have been a max loss, and this would have been trading for 10, and we would have lost $778. So through the management that we had on this trade, we went from potentially losing $778 to only losing $228. And reduction of a loss by $450, $500, that's quite frankly just as good as a gain, because like we talk about, we're gonna win a lot with this strategy. You could see it in the fact that there's really only one losing trade last week, even though a lot of these were bearish trades in a time where the market was up a decent bit, 1% on the S&P and 2% on NASDAQ. So if we could limit the magnitude of these losers, we talk about this every single week, that's how we're going to find long-term success. That's where something that could be a potential problem based off of the way that it moved against us gets mitigated severely by, doing something like rolling this credit spread up. Now, again, this could have continued to move against us, but we like to think about what is likely in the market versus what is not likely. After it had run up so much, it probably wasn't likely that it was going to shoot up again. Now, it could happen, it could happen. I don't want to sound, again, super misleading or do anything clickbaity like, oh, it's so obvious that once it goes up this much, then it's coming back down. If that were the reality, we'd be rich. This game would be a lot easier than it actually is. But with that reality and understanding what is likely, what is not likely, we rolled up and we doubled down. But in the back of our mind, we always want to make sure that we understand, like, in theory, there's nothing stopping this stock from like going up 5 or 6x again. Like, that could happen. So we stay in the call credit spread. That way, if something really goes up and crushes us, and say we even took max loss on this, our week would still be green overall. We'd take a decent hit on this one, but we still would be green overall, where we would have made a huge mistake, had something move terribly against us, but still made money on the week. So those are the types of trades that we like to take on with those stocks. And this is one we talk about second because we've continued this trade here into next week, right? Similar to RH, Restoration Hardware, even though we lost a little bit off the bat, we kept kicking it down the road. And hopefully it's going to end up in a position where we're making money on it, even though it's moved against us pretty severely. UPST, even though it moved against us, we doubled down into something. We got that gain, or got the loss down to 228. And we're up similar position for next week, where if it goes back down, we've got a 64-67 call credit spread. I like this one because at max loss, we're only losing about $555, whereas max loss on this, we're looking at something like minus 2K. But the great part about this is, we've kind of dug our heels in a little bit. We've given it another week to potentially fall back. And if it finally does fall back down below the 64 level, which happens very frequently for this one, max gain is 345, and all of a sudden this trade that was a loss last week is an overall gain. And again, we just keep making progress like that. We don't need to knock it out of the park with an individual trade. We take the losers, we try to mitigate the magnitude of that, we roll into the following week, and we just keep going week after week after week. But that is where that trade currently sits. And really the only loser that we had last week. We had some winners that probably aren't really worth talking about because we talk about basic strategy a lot, and that's what these come from. Lemonade, DoorDash. This is actually one I do want to circle back and talk about because we talk about, did we make mistakes? Did we do things wrong? DoorDash is something where I think we did something very, very right. If you take a look at this, we had an 87.90 strike call credit spread. And if you take a look, Dash, it finished at 89.52. However, when did we get out of it? We got out of it Thursday afternoon. We got a little bit of a move in our favor. We could take a look at the 5-day chart here. We knew that anything below 87 was going to be max profit for us. And as we got that move down, we saw it was trading at 86 near the end of the day on Thursday. And DoorDash, you zoom that chart out, it's no stranger to it's like some of these large candles and runs. And of course, we got a big green candle on Friday. I didn't know that was going to happen. But we had it in the back of our mind that something like that could happen. So the whole risk to reward trade-off here is, yes, it's Thursday afternoon. And yeah, I mean, if you look at just the situation we're looking at right here, looks pretty good, right? There's one more day to go. Typical range in a day is about, $1.50, $2. How bad could it really get? It could probably go to 88 maybe, and then, you lose a tiny bit more, but also could go down, could stay below this red line here. A lot of different things could have happened on that Friday to make us make money. But what I want you to ask yourself is that worth holding out for 27 cents extra of premium? Would have taken our gain from 144 to 225, which is about a 75-ish dollar difference. But you always want to think about the flip side of that as well. And the flip side of that is that there's a massive green candle the next day, and then we go from a trade where we're making money, 144, to a trade where all of a sudden we're losing money, maybe 375. And in fact, DoorDash closed at 89.65, meaning this spread would have closed at 265. So had we held, we would have lost $570 on this trade. Pretty big dent out of our weekly profits. Just like with Upstart, we said we managed our way out of a $700 loss, got it down to a $220 loss. That's like $450, $500 of improvement right there. With DoorDash, what would have been a $570 loss was actually a 144 gain because we were able to close the position on Thursday afternoon before that big green candle. I really don't like holding spreads overnight on a Thursday if they are remotely close. There are some trades where if I'm okay with rolling into the next week, taking the top off and taking those calls short naked, then there's potentially an argument for taking it overnight. But the risk of potentially having that $500 loss that we saw balanced with the reward of maybe making 75 more dollars really just isn't worth it for me. We talk all the time. We've already said it on this stream. You guys are probably like, HT, shut up. You say this all the time, but just small gains. As long as you just keep getting each individual trade to win, no matter the magnitude, right? Even if your trade is only winning $2 or $3, I don't care. As long as you get into a trade and get out of it, leaving your account higher than it was when you started, that is a really good success, or recipe for success, or recipe for long-term increases in your account, and accomplishing that goal that we talk about of just consistent income generation, avoiding the big dips in the account. Because yeah, it's nice to have big green weeks, but if we're putting ourselves and our portfolios in a position where we're taking on an amount of risk that may lead to us losing money, 2 green weeks can easily get wiped out by a red week. I'd rather have 3 moderately green weeks compounded on top of one another than a couple great weeks followed by a decently sized red week. That's just a better way to approach it in our experience. But that's the rationale behind closing out DoorDash on Thursday afternoon, and ended up in hindsight being a good move, right? I feel like there's some times, and over the last few weeks, we've had situations where I say, we did this and it was smart. Like in hindsight, it would have been better if we didn't do it, but it was smart. This is an example where we did the smart thing, and in hindsight, it was also the right thing to do, which is great. All right. And that moves us down to, DWAC. We made a decent bit of profit. In fact, that was actually our most profitable ticker uh, in the month of July. We actually cumulatively, there you go, tongue was a little frozen from the ice in there. Got up to about 760-ish bucks, I think, a profit on just ins and outs on these cash secured puts. Again, remembering that we bought the 10 strike put on it. We still have it in our account, but we paid $10 for it as insurance in case the price of DWAC moved below $10 a share. Have not even gotten near needing to use that. But there was a pretty big green candle on it. There you go. Last week up to 19.4. So really not in a position where I'm comfortable going back in. If you look at premium for next week, we liked it a lot in that 12.5, 13, even 13.5-ish level, but there's really just not any good premium down there. All the premiums around 15-ish, and if you take a look at like the 180-day chart, 15, not a good place to be when it was kind of basing, leveling off at like 1250-ish. So that is our current stance on that one. That's why we're not going to be playing that again, at least in the near term, until it comes back down. AMC, this is a great one, and I'll talk about a couple more, but this is one that really good example of you could get into a trade, get out of a trade on Monday, and still have it be a really, really nice result and not have to stress waiting the next 4 days. We say every week as well that 5 days in the stock market is a long time. So this is something we were doing on Monday morning. And while it would have worked, again, this is an example of one where we would have made more money if we just didn't touch it. But I think the smart move here was taking these profits, because look at it. We made 250 bucks in 1 day. Max profit on this was 450. So we got 50% of max profit in 1 day, or we could have got full max profit in 5 days, right? Making 250 in 1 day is better than making 450 in 5 days. That's just the way that works. So we get in, we get out, and there's nothing better than just having that profit locked in. And being one of the first building blocks of what turned into a successful week for us last week. That was our first new trade that we layered in there. But let's talk about what we were looking at and what happened and why we were able to make money on it. So what you'll see right here, which is what we love when we are selling options and selling premium, is a big spike in the stock price. You'll see it right here. And what we also love to see with this is a big spike in implied volatility. Boom. Pretty significant here, going from about 1.99, which is about 100% IV, to about 150, 160% IV. So what this does is fantastic, right? What we like to do is, one, see a big spike in the stock price. We saw that. 2, we want a corresponding spike in implied volatility. We saw that as well. 3, we want there to be a little bit of a trading base and, pretty decent trading base here in the low to mid 4s. And then 4, we wanted there to be option premium at the trading base. So what you could have happen here is when things open, when there's these big opening candles at the beginning of the day, when the stock's getting halted, unhalted, you'll typically find a decent bit of premium right here. And what we did is we started with 10 of the 4 strike puts for 21 cents. And if you look at 4, it really never even came close to 4. Not even close. The last time that it was at 4, if we extend this to the left, I mean, not even in the last 20 days, unless you count the rogue bottom of this one candle here, but I don't really count that. So we were comfortable that even if it did revert back down to the mean and implied volatility reverted back down to mean implied volatility, as it often does, we were comfortable that 4 was okay. And as it started coming back down, we didn't quite catch the bottom of this candle. So we started with 10 contracts, and then as it went a little bit further down, we added 5 more. This was a little bit more aggressive of a trade, going at a higher strike for more premium, but it was half size by only going 5 contracts versus 10. So that is kind of how I balanced that idea of, 4.5 is maybe a little bit riskier than 4, obviously, but cutting that position size in half, using 5 contracts to double down, so to speak, scale in, as opposed to the full 10 off the bat. That is how I balance that idea of risk versus reward right there. And again, 4.5, we know that 4 is pretty nicely clear of where it had been trading over the past month. 4 wasn't that bad either, or 4.5. And further, we know that we got 48 cents of premium on that. So it's not just the fact that anything above 4.5 was max profit for us. It's the fact that anything above 4.5 minus 0.48, the premium we received. So anything above 4.02 was profit period for us, which was a really, really nice risk to reward value proposition, however you want to call it, on that trade. Now, what happened was it bounced back up by, almost noon, I think. We didn't stay in this trade for very long. It only took a couple hours. So once we caught a couple of these green candles, we said, that's it. That's enough. We're done. We're going to close out. And we took home a profit of $250 in just a couple short hours, which was really, really nice for us. And yes, we could have made a little bit more if we just held till expiry. But again, 5 days in the market is a very, very long time. When you've got a stock that's going from like 8.8 back down to 5.1, even though we use this trading base as an idea of where we'd be comfortable at, getting back in on the stock, that doesn't mean it's impossible for it to come back down here, because, just a few short days later, it touched that 4.5 level. And in theory, there's nothing stopping it from going back down to 4 either. Again, it's, less than likely, which is why we enter into these trades. But of course, it's a possibility that we want to be aware of. So anytime we've got a trade like that, especially Monday before noon, it's a really, really good idea just to take that profit. There were so many trades this past week that I think we managed really, really well. LESL is another great example of a trade that went poorly off the bat. We tried to get in after a big post-earnings dip, which is right about here. We saw that there was a candle down to like 5.66 pre-market, and typically those, rogue candle wicks, you can almost call them, are a decent place to start selling premium at. So what we did is we sold the 6 strike puts for 15 cents, which would have given us a 5.85 break-even price, which is this red line right here, kind of near the bottom of that wick. But that quickly was broken down. So what do we do here? The answer is we go into the typical HT wheel. We go to step 2, which is the covered strangle. So what we do is we take this 5.85 break-even price, we sell covered calls on it at 6 strike, and that takes our break-even price down another 21 cents. And then not just the covered calls, but the covered strangle, the covered puts that we sell as well, which are these 5 strike puts here, which are going to make us $200 so long as that stock stays above 5 come August 18th, which it looks like it is on track to do. We tried a couple orders to see if we can close this out for like 5 cents and take $150 of profit. But so far, when we got the big move that we wanted, and those 6 strike calls went in the money, honestly, we kind of timed the top of the candle pretty nicely. We should be day traders. But no, I don't want to do that. We were able to close the shares out for $1,010 of profit, even though we lost $490 on the covered calls, right? They net out against each other. That's just how that type of position works. So we made $520 on holding those shares, selling those covered calls. And again, we didn't even have to wait till that August 18th expiry. It's July 30th right now. We still have about 3 weeks until that expiry, yet we were still able to take $520. That netted out nicely against the 450 loss. So even though we had this trade and really was it was our second biggest loser 2 weeks ago, it took less than 1 week for us to make all of that back and get to a net 70 gain. And then remember, we've also got these 5-strike puts that we sold as part of the covered strangle to give us 200 more bucks. So this thing's going to potentially turn into a $270 gain if it holds above 5. So that is a really, really good example of just, trusting the process. Average down into the shares, sell the covered strangle, make sure you can afford to sell the covered strangle. You don't want to be over leveraging your account and anything like this, and then just sitting back and waiting for the move. A lot of the time we see big dips like this result in moderate recoveries. And again, you don't need anything crazy, right? You just need a moderate recovery. It got very, very oversold. We saw a moderate recovery. It's now not oversold anymore. So we are scaling our way out of the position. Really, really similar idea with Snapchat as well. We sold these 728 9.5 strike puts. We sold them for 16. What do we see? We see a really big post-earnings dip. But we were comfortable with Snapchat, right? The last few earnings we've seen, of the last 3, 2 of them had pretty big dips. There was one where it went from about 1038 to 864. It went a little bit lower, but again, bounced back up. We saw one back in October of last year. Really, really big dip off this one. 1082 down to 733 at the low, but almost immediately bounced right back up. So when we see another big dip from 1253 down to about 10-ish at open, what do we expect? We expect that it may just get bought right back up, and that's exactly what happened. So we got in there with the 9.5 strike puts, and again, we choose these conservative strikes just because they're a little bit safer. 9.5 was all the way down here. So while it can be kind of scary to try to, work your way into a position when there's a massive red candle, typically the big red candles are there off the bat, especially for these afternoon earnings. And by the morning, a decent price range has been established. So if you could find option premium down here, to me, that's a decently safe trade. And if we ended up taking assignment of the shares, we take assignment of the shares. We do exactly what we did with Leslie at ticker LESL. We average in, we use the covered strangle, we sell covered calls to lower the cost basis, we sell cash secured puts to further lower the cost basis, and then we just take the hands off the wheel and we wait a little bit for the next expiry, roll the options, and we keep doing it, right? Our break-even price can go down indefinitely week after week after week, just as long as we ensure that we can afford the position, meaning that we're not using like 20-30% of our account on one position. We want to work our way into these. And it's a very good way to turn losers into winners, like we saw with Leslie, or you have 2 trades like we had 2 weeks ago with MASI, or last week with Snap, where it doesn't move against us, just flattens out, and we took them a cumulative $220 of profit off those just from paying attention to what was going down after earnings. And again, strategically, what do we want to look for? One thing that I really like looking for is price targets. So typically these will come out right after earnings, right? They're reported on 7:25, so you would expect to see a lot of these come out the morning of 7:26. And if you go to the news feed, we've got a $15 price target. We've got 11, we've got 10, 11, 9, 11. Point being there, we don't see a lot of 9.5 and below. So we were comfortable, at least in the short term, selling those 9.5 strikes, sitting back, and then just letting it play out. So that's about, a little bit longer winded of a recap, but we do so because I think last week was really, really well managed. Typically we have 1 or 2 things during a given week that we say, you know what, we probably could have done this a little bit better. Last week I think was a perfect week from a management perspective. I think a lot of the calls that we made were the right calls. Even if things move against us, we managed them in such a way where the losers, or loser singular, was really small. It was only a $228 loss, which gets eaten up by almost any position that we opened. A couple of these positions are coming into the following week. This is probably the more interesting part of the stream where we talk about what we've got for the upcoming week. So to get more of a big macro idea of what's going on in the market, let's first take a look at the S&P 500 ETF SPY. We're going to go to the 1-year chart on that. Boom. What do we see? 69.16 RSI on the 1 year. To me, that is still just so high. And yes, there was a decent red day on Thursday that took it down from, low 70s. However, there's still a decent bit of room for this thing to fall back down. It looks like it's starting to flatten out a little bit. I don't know if there's necessarily a comparable window to this, but if you look at all the times the S&P 500 gets decently overbought in the last calendar year, we talk about this a lot, starting with, even August of last year, almost a full year ago. got up to about 73.99 before it went from 432 down to 348 at the bottom, which again is absolutely not me saying that that's going to happen again, but really just any sort of short-term reversion down to the mid to low 60s. This red line here is really what I would like the S&P 500 RSI to hit before I start getting back in on the bullish side. And you can see that reflected in our positions as we have exclusively bearish positions for the coming week. And we also have some bearish, longer term positions down here that we could touch on as well. We'll talk about every single trade that we currently have open right now. But that's kind of the outlook right now. QQQ Tech, similarly, not quite as high because I think it sold off a little bit harder at the beginning or a couple weeks ago. But still, 65.6, that is very large. Until these come back down to 60 and below, I really want to be overwhelmingly bearish with my portfolio. And the first way that we're going to be doing that is with DoorDash, which we started last week. We got out for a profit. And we're coming back in this week at a higher strike, right? We had 87.90, so anything below $87.75, which is the short leg plus the credit, we're going to be making money on it. We took profit early because we got a little bit of a move in our favor. But what's interesting about DoorDash this week is that they are reporting earnings. So we took a tighter spread on this one. And the idea here is that even if we hit something like max profit, it's only a $600-ish loss. We talk about these shapes like this where there's a big drop off after earnings. There's a big drop off after earnings and then it bounces back up. With DoorDash, one, I think their earnings are going to suck. But even if they don't suck and it spikes up, I'm okay with taking the approach of, if it runs up here, that's fine. What we'll do is we'll take profit on the 92 strike calls that we bought as a part of this, probably take the 90 strike short call naked, and then just ease our way into a short position off DoorDash. Because similarly to how LESL and Snap, had these big earnings dips and then came back up a little bit, if DoorDash combined with how overbought the market already is and how overbought DoorDash is individually, right? On a 3-year basis, RSI is 78.33 on a 3-year basis. It has not been above 70 in the last 3 years. So we go to the 1-year basis. It has an 80.38. That is as high as it has been over the last calendar year. And the last time, maybe 2-ish weeks ago when it got this overbought again, it kind of flattened or fell back down a little bit. That's all that we need. All that we need right there is that flattish or downish move. So if it does overperform and have a good earnings and shoots back up, that's fine because our max loss in the short term is capped at 615. And then we could work our way back from there, playing it similarly to how we played Restoration Hardware, playing it back down in that manner where we take the calls short and just wait for it to fall back. If it never falls back, maybe we'll stop ourselves out at a certain loss, but that's plan 2 right there. And of course, if this trade goes as we want, it trades flat or goes down after earnings, boom, that is a nice $385 in our pocket, which combined with the credit spread we had on it last week for 144, nice 2-week total of 529 potentially on DoorDash. So that is what we are going to be focused on for the coming week on DoorDash. Upstart, this stock, this company sucks. It's just being shorted. It's flying up. But the danger with these things is there's really no limit as to how high they could go. Another one, though, where RSI is red hot, 72.77. So just giving ourselves a position where we have time. We have until this next Friday. And then we have not too much of a cushion because it ran up a little bit more. But we could sit back and wait with a break-even price of 65.15. So basically, it finished at 65.18 last week. Kind of a binary trade here, right? It's either going to go up, and we're potentially going to lose a little bit more money or manage the position as it goes. Or 2, it's going to go down, and then we bag $345 of profit, and we'll be good to go. But again, cross that road when we get to it. The most we can lose on this thing is 555. That's a common theme with some of these spreads that we have for next week. While the stocks may be a little bit riskier, and I think in order of riskiest to least risky on these 3 spreads, riskiest is going to be Upstart, so I do not want to take that one. I do not want to have naked calls on that. I will keep this as a credit spread no matter what. Second riskiest is Wayfair. If it gets really bad, I'll probably uncover half of it, but I don't want to uncover the whole thing. And then least risky, I think, is DoorDash, which isn't to say it's not risky at all, but in the context of the 3 credit spreads we're holding for next week, I think that's the order. Riskiest, UPST, second riskiest, Wayfair, third riskiest, DoorDash. So let's get that back to where it goes. So that covers pretty much the first 3 positions that we have here. The fourth is a short naked call position on Pulte Homes, ticker PHM. Another one where we've talked about these trends of things being very, very overbought. Boom, this one is very, very overbought. 68.25, not quite into the 70s, but what this one has a tendency to do is either, flatten out a little bit and then fall back down. Anytime it had been overbought, here's an example of it being overbought over here decently, fell back down, overbought, falls back down. Not quite overbought again, but we see these every now and then, and maybe not necessarily specific to Pulte Home, but with a lot of these high RSI tickers, we'll have something where there's just like a massive red candle, and that's our opportunity to take profit. But we started last week. This is one that we managed very, very nicely. We had an 84 strike call that we sold on it. We go to a 5-day chart. Let's talk about the lifespan of this trade here. We'll bring up the handy dandy system calculator, right? So we started with an 84 strike call, and we sold that for, what was it? 82 cents of premium, 0.82. So our break-even price was 84.82. Really not too bad of a position to be in. 84.82. That's our initial break-even price. We got into that on Tuesday morning as it started to run up. Now, as we can see, it ran up further. And what do we want to do when the stock hits our break-even price? Sometimes it can be very, very tempting to double down immediately when you hit that. But what I always say is just take the hands off the wheel and wait, because when you have a stock that is at your break-even price, as we saw on Wednesday morning, really there's one of two things that can happen here, right? It's either going to finish below your break-even price and go back down, in which case there's no need to touch a thing and your position is just fine. Or two, it's going to go higher. And while in the short term it moved a little bit lower and we were good to go, by Wednesday it opened higher, moved a little bit higher Wednesday afternoonish. So we said, okay, we waited when it touched it. It touched it again, went back down, opened above it, and then started moving away from it again Wednesday afternoon. That was the time at which I thought it was appropriate to double down on the position. So we had that 84.82 break-even price. What do we do with that? We doubled down by selling 2 more contracts, and we sell them at a higher strike, the 86 strike, for 42 cents of premium. So now that's a direct cent for cent increase in our break-even price, giving us an 85.24 break-even price on PHM. So nothing crazy, but 85.24, this red line moves up a little bit. And it doesn't look like a lot because there is a decent move off of earnings. So if we take away this earnings jump, the jump in the red line looks a little bit more significant. But any little bit of progress is always great. And what you'll notice is it finished below 86, so that's fantastic for us. When we double down like we did by adding the 86 strike call, our number one goal, obviously to profit, but our number one goal is to get out of that and go back down to that original sized position. That's exactly what we had the ability to do. So not only, because you'll notice here, it was overbought and we got a nice move in our favor, and it finished below 80, or it finished below our original red line. So we made max profit on the second trade. We made a little bit of profit on the first one, so we were up like, $106. But with that 85.24 break-even price, what we did was we took these 84 strike calls, we rolled them up, we rolled them out, and we did it for a credit, meaning that we closed them for 71 cents and we sold the new ones for $1.09. We started with an 84 strike, we rolled up to an 85 strike. And in doing so, this credit of 38 cents that we receive is a cent for cent increase in our break-even price. That takes us up to 85.62 for the coming week. And additionally, rolling our strike up from 84 to 85 is a dollar increase in our break-even price, which is why we love the roll up and the roll out for a credit, because it does some serious damage to that break-even price. So 86.62, which is all the way up here, which looks very significant now, is our new break-even price on PHM. And of course, if it finishes below 85, the strike that we rolled up to, and a strike that it closed below on Friday afternoon, we're going to take not only the $106 of profit that we had from last week, but also a $218 from this week, for a total profit of $324 on a stock that, kind of it's above where we entered into it and spent the better part of our time in the position moving against us. So again, another one where we've had some pressure against us, yet is still on track to be turned into a winner. And that takes us to the final position that we've got to talk about here on our current. That's what I get for trying to read something on my phone while talk at the same time. Our current earnings position, the last position of our current portfolio. There it is. The four Wayfair 74.76 call credit spreads. Wayfair also reports earnings this upcoming week, so this is another earnings trade. But again, similarly to the setup on what we just talked about a second ago with DoorDash, it's a company that's reporting earnings, a company that I don't think is a very good company, and two, it's a company that's pretty overbought. And there's some serious resistance here at this 74, 75, 76-ish level you'll see. So what we did was we took a similar approach where I would love to work myself into a short position on Wayfair, because this is one where I think you look 1, 2, 3 years down the road and it's absolutely lower than where it's currently trading today. But of course, also could be one where even though the company sucks and might have some liquidity issues, there's nothing theoretically stopping this from doubling again. It's one of those where the risk is what happens. I think I have a pretty good idea of what's going to happen between now and the end of the potential, timeline of this trade. But the issue, of course, the risk comes with what might happen in between. We know it's going to go from here to here. I shouldn't say we know. I feel like I would get mad at myself for saying that. But we have a decently educated guess that it's going to go from here to here. But of course, the risk is that on the way from here to here, it goes, way up here, and we can't really afford to keep that position in the meantime. So similar idea here to DoorDash. We took a really tight credit spread, $2 wide, a little bit more directional, right? Wayfair finished at 73.09, and we've got a 74.80 break-even price for the coming week on this one. So it's 2.34% cushion. But of course, with earnings coming up, 2.34% is kind of nothing. So what I do like about this approach is that one, I think Wayfair is going to suck and have a bad earnings cycle. And if it does, that's going to be $320 of profit in our pocket. What I also like about this is that since we are of the general belief that the market is overbought and potentially is going to come back down, if that does happen between now and when Wayfair reports earnings, we could potentially just get out of this trade, right? We don't even need to take on the earnings risk. If the market falls back and Wayfair falls with it and we can close for like 50 cents, there's nothing wrong with bagging $120 of profit and avoiding that earnings risk. I think that'd be a fantastic result for us, right? If it drops down a few bucks and we can close it out for 0.4, we're like 0.3, all of a sudden we're looking at $200 of profit without taking on the earnings risk. Now, I doubt that we're going to be able to close before for like a 0.3. I think something in like the 0.4, 0.5 range is a little bit more reasonable. But again, there is no profit like guaranteed profit in the market. And not guaranteed in the sense that if you open this is what's going to happen, but guaranteed in the sense that if you're looking at a trade where you could take $120 of profit today, but earnings are tomorrow, and the potential reward is 320. I'm taking the 120 every time. You take the profit, get your chips off the table, and just continue building trade after trade after trade. Because of course, if this doesn't go our way, all of a sudden it's a loss of 480, and the difference, while making 120 may not seem a lot in comparison to making 300, there is a very significant difference between making 120, having it go against you, and then losing 480. That's a $600 difference right there, which is what we want to avoid. So that is the game plan with Wayfair. We're going to watch it. If it goes back down, we'll try to close it before earnings. And same idea with DoorDash as well, what I should mention. I liked the idea of doing that at the end of an overbought week. Typically, if I want to play earnings, I'm waiting until right before they're reported, meaning, if they're reporting Tuesday afternoon, I want to, open this position Tuesday at like 3:50, 3:55 p.m. Eastern, like 5 to 10 minutes before the bell rings. That way you're purely playing earnings. But with an overbought market, if I have a bearish trade on earnings, playing it right at the money, a little bit tighter spread, I think is a great way to do it because there's two ways we can win, right? Like I just talked about, it could go down before earnings, we close out, or it could go up before earnings, and we don't care because we think earnings are going to be a volatile event. So if it goes our way, any pre-earnings move probably isn't going to be enough to make our trade a loser if it goes the way we want for earnings, if that makes sense. So that's the idea there. If we hit max profit on everything, we're looking at a profit of $2,193, which would be a fantastic result for us. And for that reason, I'm not terribly inclined to add too much more Monday morning. If we look at the economic calendar for the coming week, boom, that's right here. It might be a little small on your screen. Sorry about that. There really is only one somewhat important event, and that's going to be Wednesday, 8:15 a.m. We've got some non-farm employment change. We've also got on Tuesday at 10 a.m. some manufacturing PMI, but typically that PMI that drops during trading hours, right, that's 10 a.m., not as consequential or impactful as some of the pre-market type data you'll see on like a Thursday or a Friday. We've got average hourly earnings, non-farm unemployment, that can move it sometimes, but nothing as crazy as like CPI, FOMC. Those are the big ones lately that we've wanted to look out for. Now, from a market their perspective, that's not a lot of risk, but I think a lot of the risk in the market this week, give me a second here. Let me go to the Discord server. Please ignore the dead air as I try to pull this up. Boom. There it is. Boom. Probably mistimed that. There are a lot of big earnings coming next week, and this is honestly what I would mostly consider to be the peak of earnings season. Whereas the past few weeks there are maybe 2 or 3 names that we were able to pick out and say, keep an eye on this. This will be pretty interesting. There are a ton for this coming week that we could say, keep an eye on this. This is going to be interesting. SoFi Monday morning, keep an eye on that. Uber Tuesday morning. Lyft could be a sympathy trade based off of that. Wait to see what happens there. Nothing else, I think, Tuesday morning, but Tuesday after close, we've got AMD, we've got Pinterest. Those could be some pretty big movers as well. Solar Edge, pay attention to some of these solar companies because last week, I believe it was they released some pretty bad guidance. They're a solar company and it kind of sunk solar as a whole. Solar typically, starting to come back down from a valuation perspective, still a little bit above where I would like it. However, it's an area with a lot of option premiums. So after this cycle of earnings for solar companies, if they get knocked down, I'm definitely going to be a buyer and or a put seller to be a little bit more literal for some of these things. Wednesday before market, nothing too crazy, but Wednesday after close, it'll start to get a little bit crazier again. We've got PayPal, Shopify, Unity, Robinhood, Etsy. That's 5 names right there that typically have some very, very significant moves in the market. Thursday morning, we've got Wayfair, which is one that we're playing. Nothing else too crazy Thursday morning, but Thursday afternoon, Amazon, Apple, Coinbase, Block, Airbnb, DraftKings. That is 6, potentially 7 with Wish, stocks that typically have good premiums and are reporting earnings. I really am bearish on Amazon earnings. Reason being is that Microsoft just presented earnings. They had some pretty bad forecasts or pretty bad numbers with the cloud business. That could directly tie into AWS, which, if Microsoft reported bad earnings in that manner, you would expect to see Amazon take a little bit of a hit as a result. However, on the back end of last week, it recovered very, very, very nicely. Amazon is kind of an overvalued ticker. It's coming back a little bit up against what we might consider to be some resistance here at 145. It's overbought right now on a 3-year basis, getting up there on a 1-year basis. But this is Amazon, one that I may think about taking a little bit wider of a call credit spread on. Honestly, it's just going to depend on how DoorDash, how Wayfair go before that. If we've got both of those in the bag with the win, I'm absolutely happy to press my luck with Amazon, play that one bearishly as well. Everything else, I think, is going to be firmly sit back, wait and see type approach. Remember what we did with Leslie. Remember what we did with Snapchat. Those stocks that have really, really big dips are going to be decent candidates to potentially sell deeper out of the money puts if we can get comfortable with the valuation and comfortable with the reason behind the drop. Likewise, if there are any that run up a ton, we also could potentially get back in front of those as well. One example, and what we did last week, this will be a nice little segue into some of our longer term holdings that we're going to talk about to close this stream out, was Roku. You'll see that right here, row 844, Roku. This thing jumped up a ton off of earnings. That is a massive green candle, which made it overbought 71.84 on the 1 year. Looking back at the 3 year, yes, it traded much higher, but this was the big tech post-COVID bubble. Really just don't think we're going to be getting back up there anytime soon. I think looking at the 1 year plus-ish time frame is going to be a lot better for us here. Now, it really, really broke through this 85-ish resistance, which is a little bit okay, this thing's moving. But the great part about this position is, one, it's a single-sized contract. It's 90 to 100. So we know that, one, it expires on August 18th, so we have at least 3 weeks to sit back and wait for it to cool off. 2, we know that our break-even price is going to be 90 plus that 2.17, so 92.17, which is above where it closed on Friday. And 3, of course, it's a credit spread. So even if it shoots up to 200 tomorrow, the most this can be worth is 10. The most we'd lose is 783, and then we just take that into a short position, potentially double down, treat it like we've treated Restoration Hardware, but kind of go from there. I really, really like these longer-term call credit spreads that we have been opening. I say longer term. Typically, when you're talking about investing and say something's longer term, it's like a year. But these are really like 2 to 3 week call credit spreads. And the reason that we've been going into these is that we have had several call credit spreads where we have taken on the basis of RSI and then been off slightly with our timing on these weekly spreads. By going 2, 3, 4 weeks out at a given time, we're able to one typically get a larger cushion, which makes sense because you'll get a larger cushion the larger or the longer you go out, which that adds up. But two, you can kind of treat this in the way that the market moves up and down. Yes, it may move up against you off the bat, but when it cools off and goes back down, you could take profits. You don't need to sit here and say, as of August 18th, this stock needs to be at this price. No, because any day between today, July 30th, and then August 18th, if it gets to a price we want, we could just take early profits and we're good to go. So that's the idea with that one. Similar idea with NVIDIA. This one has just kind of been a monster. We talked a little bit about how we played Restoration Hardware and we've kind of taken it naked and we're potentially in line to make $600. NVIDIA was the first one that we did that on, and we actually ended up making like $1,400 off it. So if this can cool off again, take a look at this chart. This thing is just will not stop. If it can cool off again, we'll bag $700, and it'll be one of our more profitable tickers on the year, even though it moved against us both times we traded it. But just giving yourself that little extra cushion, little extra time to just sit back and say, hey, hopefully this will move in my direction, but I'm going to give it time to move in my direction. We need some time to have the thesis play out. Same with HELE. We started with one, and this is one that we doubled into, right? Because we know that our initial break-even price, if we bring the calculator back up, we sold the 130, 145 strike. I mean, I thought that was a pretty good initial entry for a 134.55 break-even price. Now, it went a little bit higher on us. This thing keeps scooting up, and as such is at 82.82 one-year RSI. But another example of like, look, this is just a move that is out of the ordinary. It's kind of this low 140s level looks to be some sort of resistance, we hope. And if it falls back down, we're in a decent spot. But we started with the 134.55 break-even price. We like that 818 expiry so we could sit back and wait. It ran a little bit against us, but what we were able to do is we were able to double down with another call credit spread. So we sold that for $295. That's a direct increase to our break-even price, meaning our new break-even price is $137.50. So, in short, what's great about this trade is that we entered this, and we also had one right around here, and on these red candles, we took $200 for C Blue. Appreciate the follow. We already bagged about $200 of profit on HELE just off these spreads, but I'm not going to factor that in because I feel like that's cheating a little bit. But just know that we already had a successful one with this. But we started with it at about 130, right around here when it kind of went back up. Our break-even price was 134, and now our break-even price is 137.50, which if we go here is right at this red line. So on a longer-term basis, this is a decent place for us to play it back down from. We've got about 18 days until this thing expires, and hopefully it falls back down below that red line. And the great part here, now since we've doubled down, is if it goes all the way back down to 130, we overall make 750, which is more than, obviously, it's more than the 455 that we started from. So it serves two purposes. Not only does it raise our break-even price, but it also raises our max profit. The flip side is we now need a move in our favor, where so often off the bat we just need something to trade flat or go in our favor, but we can have both outcomes and be successful. But that's where that's sitting. So that should cover pretty much all of these long-term holdings we have. And I've really liked the idea of just kind of building these up and having like, 1,500-ish of potential profit at a time. Now with what NVIDIA and HELE did over the past week, that number is much lower. But again, if these things trade flat, yeah, they've moved against us, but in aggregate, that's going to be $359 we add to our normal weekly portfolio to kind of cushion it a little bit. If these things move in our favor, all of a sudden we've got $2,000 that we get to add to our portfolio in a few weeks. And of course, if we get moves in the meantime, we could take somewhere in between option 1 and option 2 and maybe only realize 1,000, but we're getting out of these positions and taking risk off the board. But I think it's a great way to play some of the riskier, more overbought trades, because when something is overbought, you never know when it's going to top out. When something's riskier, again, not knowing when it's going to top out, having the credit spread, the defined gain, and more importantly, the defined loss, is a great way to approach those. So that's what we got. Last week took home a profit of $2,212. We wrapped up July with a profit of $5,405. We're just continuing to make profit. Yes, we're underperforming the market slightly, but again, big point here, we're doing it with the bearish portfolio. We're not dependent upon the market going up. And in fact, we would do even better right now if it went down. So don't let that distract you from the goal here. We've got a somewhat neutral, I mean, it's not neutral this week. We've got an overall neutral approach to the market. And I'm comfortable with where we sit. So it is 10 o'clock. We have effectively made it to the end of the hour. Thank you guys who tuned in. If it was your first time, hopefully you'll come back and join us again next week. Same time as we hopefully talk to you with a little bit more money in our account than we have right now. Go to hourglass-trader.com. There's a big purple button that'll let you join our Discord server. Big reason we do these weekly streams, big reason we make the videos, big reason we have the Discord server. It's always going to be free to learn what we do. But if you do want that extra little boost, you want to get alerted to our trades as we use them, you want to get the links to our scanners so you could scan how we scan and identify opportunities the same way that we are. Hourglass-trader.com. You can sign up for HT Premium. I think all the plans pretty much come out to less than $1 a day. We're not trying to crush anybody, but just takes a good bit of effort to put the streams together, the videos together, alert the trades, talk in the Discord server. So that's the time we're putting in for you guys. But if you want to sign up and support us, that is where you can go to do that. But that's pretty much all I got. Cannot thank you guys again. Cannot thank you guys enough for tuning in as much as you guys do. Hopefully we're going to get the numbers up. One of these days we are going to get 30 live viewers and give away one of these HT tumblers. You could guarantee it. But until next time, this has been the Hourglass Trader, where as time passes, we make money, and we will see you guys same time next week. But in the meantime, hit us up in the Discord server. Hope everyone has a great week, and thanks again for tuning in. See you later, Jules.